Hey, welcome. So, do you think options trading is some kind of complex code that only Wall Street insiders can crack? Well, if you do, you've come to the right place. We're about to demystify the whole thing by breaking it all down into 7 super simple rules. Let's dive right in. So, here's our game plan. We're going to start with the 3 golden rules that everything else is built on. Then, we'll get into the fun stuff, the up bet with calls and the down bet with puts. After that, we'll figure out how to tell if you're making money, how to actually place a trade, and then we'll wrap it all up with the big takeaway. All right, section 1, the 3 golden rules. Seriously, think of these as the laws of physics for options trading. Every single contract is governed by them. If you can get these down, trust me, the rest will just click into place. Okay, rule number 1 is the expiration date. This is the first, most simple fact you gotta know. Every single option has a ticking clock on it. See, unlike a stock you can just buy and hold forever, an option contract literally vanishes, poof, after its expiration date. This means you have to be right about which way the stock is going before that time runs out. Next up, rule number 2, the strike price. The easiest way to think about this is like the option's fixed price tag. It's the price that's predetermined, the one you can use to buy or sell the stock. Now, the actual market price of the stock might be bouncing all over the place, but your strike price, that's locked in. And that is where an option gets its power. And rule number 3, the contract multiplier. Okay, listen up, because this one is a biggie. One single option contract always controls 100 shares of stock. Always. So if you see an option priced at, say, $2, its real cost isn't $2. It's $2 times 100, which is $200. And that total cost has a name. It's called the premium. Now that we've got the basic rules down, let's look at the first tool in our toolbox. Welcome to section 2, the up bet, better known as call options. This is what you use when you're feeling bullish, when you think a stock's price is about to go up. So what exactly is a call? It's pretty straightforward. A call option gives you the right, but, and this is important, not the obligation to buy 100 shares of a stock at that locked-in strike price anytime you want before it expires. You're basically placing a bet that the price is headed north. And this right here, this is the core appeal, the reason people get so excited about options. I mean, think about it. If you buy a stock and it crashes, your loss could be huge. But if you buy an option, the absolute most you can ever lose is the premium you paid to buy it. That's it. Your risk is strictly limited, but your potential for profit, it's massive. And this chart just shows you the incredible power of what we call leverage. Check this out. In this example, Tesla stock went up by a respectable 3%. But look at the call options value. It absolutely exploded by 15%. That's a return 5 times greater. This is exactly how a small move in a stock can create a gigantic gain for you as an option holder. Okay, so we've covered what to do when you think a stock is going up. Now let's flip the coin and look at the other side, the down bet, or put options. This is how you can actually profit if you are bearish and you think a stock's price is about to take a nosedive. A put option is literally the direct opposite of a call. It gives you the right, but again, not the obligation, to sell 100 shares of a stock at that preset strike price anytime before it expires. You're basically making money as the stock price falls. And here it is, plain and simple, side by side. You think the stock's going up? You're bullish, you buy a call. You think it's going down? You're bearish, you buy a put. It really is that straightforward. So you might be asking, why buy a put instead of just shorting the stock? Well, the answer comes down to one word, risk. If you short a stock and it suddenly skyrockets, your potential losses are theoretically unlimited. That's scary. But with a put, your maximum loss is capped. It's just the premium you paid. It's a much, much safer way to bet on a decline. Let's move on to section 4. It's time to learn how traders talk. They use these specific kind of cool terms to describe if an option is profitable at any given moment. The whole concept is called moneyness. And this is the key question, isn't it? If you're holding an option, how in the world do you know where it stands? Like, is it actually valuable right now? Or is its value all just based on future potential? Well, there are 3 simple terms that answer this perfectly. So here are the 3 states of being for any option. An option is in the money if it has real built-in profit right this second. It's at the money if the strike price and the stock price are pretty much identical. And it's out of the money if the stock still has to move in your favor for it to become profitable. You see, an options price is really made of two parts. Intrinsic value is the real, actual cash-in-hand profit it holds right now. Extrinsic value is basically everything else. It's the value of the time left on the clock and the potential for the stock to move. You can almost think of it as the hope that you're paying for. Okay, we've covered a ton of theory. Now let's get our hands dirty and get practical. Section 5, how to place a trade. When you open up your trading platform, you're going to see a few key terms over and over. Let's break down what they actually mean. In any market, there are always two crucial prices. The bid is the highest price any buyer out there is willing to pay. The ask is the lowest price any seller is willing to accept. And that tiny little gap between those two numbers, that's called the bid-ask spread. Next, you want to look for signs of life, for activity. Volume tells you how many contracts have been traded today. Open interest tells you the total number of active contracts that exist right now. You want to see high numbers for both. Why? Because it signals a liquid market, which just means it's super easy to buy or sell your option quickly and at a fair price. So how do you make sure you get the best possible deal? It's a really simple three-step process. First, look at the bid and the ask prices. Second, find the mid price, which is just the number right in the middle of those two. And third, always try to place your order at that mid price first. This one little trick helps you avoid instantly losing money to that bid-ask spread. All right, we have covered a ton of ground today. Let's bring it all home and wrap everything we've learned into one big final takeaway. This is your brand new foundation for understanding options. Okay, let's lock in our 7 simple rules. 1. Every option has an expiration date. 2. Every option has a fixed strike price. 3. One contract is 100 shares. 4. Calls are for when you think the stock's going up. 5. Puts are for when you think it's going down. 6. Moneyness tells you if you're profitable right now. And 7. When you trade, always aim for that mid price. And there you have it. You now have the vocabulary and the core concepts to actually understand the world of options. You've basically cracked the code. So the only question left to ask is this. Now that you've got this new foundation, what's the first thing you're curious to explore next?